So I'm recording this video on Thursday night, and it's going to be going up on Saturday morning. And this is going to be about sort of stuff I've already been talking about for the past few weeks, but something that I think y'all should always remember. So earlier this week, the market went down. The stock market went down, and there were people, like every time that the market goes down, that were panicking about this and panic selling and whatnot. And there's actually been talk of the market going down for quite some time. In fact, even late last year, there was talks about the market going down. Now, why did the market go down? That's a long story I'm not going to get into. It has to do with treasury funds and things like that. It's a lot to explain, and that's not what this series is about. This is investing for beginners. If you really want to know details about this, you can always look it up, but it's really not that important, in my opinion, when you're first starting out with the investing. That's something you want to look into when you're kind of a little bit more seasoned, you kind of understand these phrases a bit more, right? But again, like I always say, when I make these videos, I always say, I am not a trained financial planner or anything like that. I'm not a licensed financial, advisor or anything like that. I'm just a guy who invests, who's been doing it for 6 years, and who's done pretty well, I would say, and who's studied this a lot. But the key word is study, which is what I'm always telling you guys. Do your own research. Do your own research, and not just on YouTube, although there's plenty of people to watch on YouTube, plenty of different channels about investing. Don't get confused, but the idea is to watch a lot of different people and maybe come up with your own conclusions, but also find the right literature. Not something that's too old either, because there's a lot of antiquated ideas about investing. If you go to the library and find a book about investing and it's like 30 years old, you're probably going to get some dated advice. You know what I mean? Be practical about this. But again, do your own research. So I wanted to make this video about the market going down. And when the market went down, I was hitting up a bunch of my friends and I was like, yo, the market's down. This is great. And I was like, it's a perfect time to put in. Perfect time to put in. When the market goes down, right? When you've been doing this a long time, when you've studied the history of the stock market, there have been rumors of a stock market crash, like I said, going back weeks, all the way since December. And there's probably going to be a crash at some point. There was a crash last year, and it bounced right back up. There was a crash in 2008, in 2000. There's been market crashes multiple times throughout history. There's been some really bad ones too, but only about, 4 times, I think, in the history of the market has the market ever crashed, like, really badly. It's always come back up. And you have to always remember that. You have to remember that when the market is going down, when you are seeing your money go down, it may only be temporary and most likely will only be temporary based on the history of the market. The market has historically gotten bigger and better every single year. Companies get bigger, the market gets more, there's more investors coming in, more people are getting involved. It's like a big pie that's just getting bigger and bigger. And so because of that, the bigger the pie, the bigger the piece, right? If we cut it out evenly. You have to always remember that. Obviously, if you had put in 10 years ago or 20 years ago, many of you, including myself, we might be pretty damn wealthy. Can you imagine putting in $10,000 when Amazon first opened up? You would be a millionaire. Probably. I have to do the numbers on that. You'd probably be close to being a millionaire by now. Probably past that. Probably way past that, actually. Right? Just think about that. And so, putting in as soon as possible is important. Now, a lot of you guys are getting your tax returns back. A lot of you guys are getting your stimulus checks now. And it's a great opportunity now to invest. Now, obviously, earlier in the week, it would have been a better opportunity because the market was down. But the way the market grows, you're always going to end up making money if you're in this long term. Some investors, some people go in with a 1 to 2 year plan and they come in, they get out. And I've talked about in the past, that is not what I do. And that's not what a lot of rich folks do. What they do is they have a long-term 10, 20, 30-year plan. And the plan is to continue to invest and put in what you can when you can and just let it grow and grow and compound and compound and compound so that when the time comes for you to take that money out, when you are older, when you actually need that money, when you are past the age where you want to work or you can even work, depending on your health, you got it there. And you don't have to worry about social insecurity, as they call it, You don't have to worry about getting put into a home by your children. You know what I'm saying? You don't have to worry about having a roommate when you're 45. Hopefully, by the time you're 45, 50, you've got a house. And it's either paid off or almost paid off. I want that for all of you. I really do. I'm very blessed to be in my mid-30s and have my house paid off. Very blessed about that. And I worked real hard to get there. And it's paid. And the amount of relief that I felt when I paid that house off was something else. Because that means I will never be homeless again. Ever. And that feels really good. Because I was homeless once. That is a good story. That is a story that all of you should look at and say, I want to be like that someday. I don't ever want to be homeless. And now the focus of my life is to invest. So that way when I get older, I don't have to worry about being unemployed and, oh man, I got to go fill out an application, do a job interview. It's annoying. Let's be honest. Job applications and job hunting is annoying. I don't know anyone who likes doing it. And you don't want to do that shit when you're in your 40s and 50s. You want to be past that, right? That's what I'm here to help you with. So you have to look at these things from a long-term perspective. Short-term, people who do short-term investing were losing their ass last week. Me personally, I can tell you that I lost over $10,000 in 2 days. Oh my God, Geekdom, you lost 10 grand in 2 days. Aren't you sweating? I made 5 grand of that back in 1 day when the market started going back up again. And I'll make the other 5 grand back next week, if not more, because I put more money in when the market was down. See, the way it works is that when the market goes down, everything gets, well, not everything. Depending on what goes down, because tech is what went down this week. And again, I'm not going to go into why. But when a stock goes down, it becomes less expensive. And when it's less expensive and you buy it at a discounted rate. So let's say, I'll break it down for y'all real simple because this is investing for beginners, right? So let's say that you want to invest and the company's going for, let's say $100 per stock. And you buy 2 shares for $200. Let's say that company blows up or does well the next week and now that stock is now worth $500, right? You've just made a profit. A significant profit at that. You just made a $400 profit on each of those. That's $800 on each stock. Now, I'm using basic numbers. It's not like that. It's usually like, it doesn't grow that fast, and usually it's like, point something, something, something. I'm just using simple numbers for y'all. And then whoever buys in at that rate has to pay the more expensive rate, And if it goes down, and you buy in then, you buy low and you sell high. Now, in our case, people who are long-term investors, we don't sell at all because we know that long-term, it's going to be going up no matter what. We don't need that money right now. And we don't want to pay taxes on that money right now. You see what I'm saying? I already pay enough taxes being self-employed. I don't want to pay more taxes. And I still have to pay taxes on my dividends. So it's always a good idea to just keep the money in there and let it accrue interest and not to sell it because you have to pay capital gains tax on it. And of course, it's different tax depending on what you're selling and what we're talking about here, but in general, that's what it is. So the idea is that when the market goes down, that's a perfect time to put money in. And since all of y'all are now getting your stimulus checks and getting your tax returns, if you have extra money you're willing to invest, if you want to invest, the perfect time is to do it now. Like, not the perfect time, but a good time. Let's just put it that way. The market might go down again even more this year, but it's always going to come back up because it always has come up historically. It comes up. Just look at the history of the market. It always comes back and better. So even if you were to put in when it's high, if you leave it in, it's going to go higher over time. The idea is to think long-term, not short-term. And people who think short-term, they panic sell, they get scared, they're like, oh, I'm going to lose my money. You should not be putting money in the market that you need. You should not be putting money in that's going to go to your emergency fund, that's going to go to your bills. You should not be doing that. Whatever money you put into the market should be money that you're willing to not touch for decades. I'm not kidding. It's the best way. And when you look at the market, if you are a person who is prone to having anxiety or prone to making rash decisions or to an impulsive person, maybe you'll want to not check your account for every single day like some people do, or every week. Maybe it's best to check it every month. Maybe it's best to learn some self-control, some emotional self-control, maybe some meditation before you put in, because you want to be able to ride out the wave. Because people who are very wealthy people who I know, have ridden out the wave. They rode it out during the 2000 crash and the 2008 crash. And they made more money now than ever because they continued to invest even when the market went down. Because if you continue to invest when it's down, that money will be valued higher over time. And the goal here is to beat inflation. Because having money in a bank account, in a savings account, or in a money market account, having money in one of those accounts, you're going to grow it at 0.00001%. It's garbage. It's garbage. You cannot get rich on a money market account. Nobody ever has. Nobody's ever gotten rich on a money market account. I can guarantee you that. You don't get enough interest back. Savings accounts are fine if you're doing, actual savings for rainy days and maybe short-term educational things, or maybe saving up for a car. That's different. We're talking about long-term investing. Don't put money into an investment account if you're saving for a car, bro. Just put it in if you don't want to touch it for 10, 20, 30 years. Maybe more than that. It's up to you. It depends on how you do, and how comfortable you feel. And you should be putting money in when it goes down and when it goes up, because of dollar cost averaging. You will want to put money in frequently. It's not about timing the market, it's about time in the market. The more time you have money in the market, the more successful you will most likely be, because you'll have more time for it to accrue compound interest, and your money will grow and grow and grow. That's the idea. It takes time. And while you're putting money in, live your life. Go get your jobs, go work on your career, work on your relationships, get your money up, get your businesses up, whatever you got to do, do it. And then as you are doing it, if you have a little extra change, put a little bit in, put a little bit in, put a little bit in. I'm not going to tell you how much to put in. Some people can put in $100 a week, some $100 a day. It's up to you, yo. It's up to you and how much you have. Just remember, don't put anything in that you need. Put it in knowing you're not going to touch it for a while. Because if you touch it, you're going to be in trouble. You won't be in huge trouble, but you're going to pay taxes. You might lose it because of the decrease in funds. You just want to leave it there for a long time. Investing is a long man's game, at least what I do. I'm not a day trader. If you want day trading advice, this is not the channel for you. It's not what I recommend doing anyways. Most of us just don't have time or stress levels, stress control or patience and research to do day trading. Most of us have lives to live, right? So the best thing to do is to put in and not think about it. Or at least, let me rephrase that. In my opinion, the best thing to do is to put in and to, if you are new, because this is for new people, go with a mutual fund or an ETF fund that covers multiple companies. That way, if one goes down, the other one can go up. If Tesla goes down, my Apple stock will be okay. If Apple goes down, my Microsoft stock will be okay. If Johnson & Johnson goes down, my Pepsi stock will be okay. That's kind of how it works. And I've talked about mutual funds in previous videos. Check out the Speak Them playlist on this video, or on this channel. Go to my channel, go to playlist, go to Speak Thems. And there are videos there called Investing for Beginners series. And it should be the last few Speak Thems I've done. And we talk about that kind of stuff there. And that's one of the things that I preach is, mutual funds when you're first starting out. Whether it be Vanguard, Fidelity, there's tons of companies out there. Those are my two favorites. They have all kinds of mutual funds, and it can be confusing. Take your time, but don't take too much time, because you can put money into a Roth IRA now for 2020. You have a $6,000 limit on Roth IRAs, and the expiration date to put in for 2020 is last year. So if you've got money lying around you want to invest, hold on, let me rephrase that. I messed up. For the 2020 contribution for a Roth IRA, the maximum you could put in every year is $6,000. And for 2020, the deadline to put in for 2020 is going to be April of 2021. You've got about a month left. April, I think 14th or 12th, something like that. April 12th, 2021. So if you have like 12 grand lying around, If you do, you could put 6 grand in 2020, 6 grand in 2021, and you're set for the rest of the year until next year. You are good to go until January of next year. And if you are going to be getting that 2021 money later this year, then put in for 2020 as much as you can, even if you don't hit the 6K, and then put in for 2021 as you start making more money later this year. That's how it works. They give you an extra 3 months, January, February, and March, to put in for the previous year. So if you have extra money, look into getting a Roth IRA, because you will grow money tax-free. And when you take money out of it, when you retire at 59 and a half or older, depending on when you want to retire, officially retire, not, you can retire young, but don't take money out until then, for the Roth IRA. Then you can take it out tax-free. You can literally earn yourself millions tax-free. If you are young enough, disciplined enough, and you put in enough, you could literally get back millions tax-free. If you pick the right mutual fund or funds, you can buy more than one. And that's another thing, diversification. The market went down. Was I worried? Not really, because I'm diversified. I have money in all kinds of different things. I've got all kinds of different companies I'm in, different kinds of mutual funds, different companies I have mutual funds with, and fund managers, and different single stocks. And a lot of people who are very wealthy choose to put money into mutual funds more than they do single stocks. Some super rich folks have, like, I think 70% of their wealth or less, sometimes 60, sometimes 80, in growth stock mutual funds or market funds, ETF funds. Because funds, whether it be ETF or mutual, are multiple companies, and they tend to be a lot safer. You have to pay an expense ratio for them, yes. It's a little bit, not a lot, if you go with, depending on what fund you get. But it's worth it because it prevents you from getting stressed out. And over time, you'll make so much money back, most likely, that you ain't got nothing to worry about. And again, there's never any guarantees when it comes to investing. But just look at the history of the market and how things have worked for decades and decades and decades. And you will see that this is a proven formula for many, many people. So if the market goes down, don't sweat it. It's going to go down. I assure you that in your lifetime, in our lifetime, we may have 4, 5, 6 crashes. We'll probably have more than that, like little ones, probably only a few big ones. But unless the U.S. becomes a third world country, you ain't got to worry about losing that money forever. You really don't, because it'll bounce right back. And if you buy when it's down, if you happen to have some extra money lying around, you buy when it's down, then you will reap the benefits long term. You really will. Anyways, that's my little preach for this week. I hope you enjoyed it. Thanks for watching, and I'll talk to you all in the next one.